Today we're going to continue to talk about trading soybeans. I think I've inspired myself to do more of it. Stay right there. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back to our channel. Last week we kicked off a two-part series on trading soybeans. We talked about what trading soybeans means and briefly covered how to go about the actual trading. This week we'll talk about the best time for trading soybeans and give you a few strategies for doing it. Our intent is to give you a basis for your own research into trading soybeans and other commodities. So, when is the best time for trading soybean futures? Yes, this is the million-dollar question that's in the back of every soybean trader's mind. When it comes to trading and investing in soybean trading companies or trading soybean futures, timing is everything. Luckily for us, the seasonality of commodities makes it easy for us to time the soybean market, since weather directly affects soybean price and yield. There are seasonal soybean trends that may recur at regular intervals. Now, in order to understand the soybean seasonal cycle, you need to understand the soybean production process. Any disruption in the production cycle can lead to some type of supply and demand imbalances, which subsequently can seriously impact the soybean price. The soybean production cycle follows three distinct stages. The planting season is done April through mid-May. Soybean future prices tend to go up during this time of the year. Soybean growth stage, future prices are affected depending on the soybean pod development. And soybean harvesting is done October through November. If there are delays or crop diseases, the soybean future prices can fall. On the other hand, if there are record soybean crops, the soybean futures prices can rise. This chart shows the soybean seasonal cycle as the average historical percent change in price each month. The key seasonal patterns to keep in mind are mid-June and September tend to produce major swing highs. This is the best time to sell soybeans. And August and October tend to produce major swing lows, and this is the best time to buy soybeans. This soybean chart illustrates just how effective a strategy based on the seasonal cycle of soybeans can be. There are many ways to trade this market, but here are some of the most popular soybean trading strategies: grain spreads, crush spreads, and reverse crush spreads. We won't go into great detail about trading option spreads in this video. If you want to learn more about option spreads, you'll find the link in the description box below to help you out. I'll be doing a video on both the seasonality trading strategy and option spread strategies in the next few weeks, so watch for them. In a nutshell, a spread position is when you buy and sell an equal number of options on the same instrument, but with different strikes or expiration dates. A spread position can also use two different instruments that are normally in correlation with one another. According to the CME Group data, the most popular soybean option spread strategy is the call vertical spread. Other soybean option spread strategies include put verticals, straddles, strangles, and horizontal straddles. We'll start with the grain spread, the easiest of the three soybean trading strategies. The grain spread is also known as the soybean corn spread. The soybean price is highly correlated with other grain crops such as corn. Because the price of the two commodities, soybean and corn, move in tandem, commodity traders can look for price divergences to make a profit. The soybean corn spread strategy requires finding out the ratio of corn to soybean. The corn to soybean ratio is greater than historical levels, then the soybean price would be overvalued. If the corn to soybean ratio is lower than other historical levels, then the soybean price would be considered underpriced. Here is the soybean-corn ratio for the front month futures. By the way, you can get this same soybean-corn ratio chart from TradingView. In the Instrument Search tab, simply type in ZS2 exclamation point slash ZC2 exclamation point, or whatever the corresponding month contract happens to be. These are the ticker symbols for soybean futures and corn futures. When the soybean-corn ratio is above 3, it signals that farmers are getting 3 times more money for every soybean bushel than corn. In other words, there are a lot more soybeans than corn. According to the supply and demand law, soybean prices will drop whenever we experience this. To take advantage of this price discrepancy, you can directly sell soybean futures whenever the ratio is above 3. You can also construct a soybean-corn spread with 2 legs using a ratio of 1 to 2. The 1 to 2 ratio means we're buying 1 contract of soybean for every 2 contracts of corn. We have 2 scenarios. If we expect the soybean-corn ratio to decrease, we sell 1 soybean contract and buy 2 corn contracts. If we expect the soybean-corn ratio to increase, we buy 1 soybean contract while at the same time we sell 2 corn contracts. Now let's take a look at the crush spread. The crush spread options trading strategy involves combining 3 separate positions: raw soybeans, soybean oil, and soybean meal into a single position. In other words, this is a 3-leg option strategy. It's called a crush spread because raw soybeans must be crushed to extract their oil. The profit from the crush spread comes from the difference between the raw soybean price and its byproducts, the soybean oil or soybean meal. The long crush spread involves buying raw soybeans and selling soybean oil and soy meal contracts. The idea behind the crush spread is that over time the prices of raw soybeans and its byproducts will adjust. We also have a reverse crush spread. The reverse crush spread is the opposite of the crush spread. In other words, this is the short crush spread. This means we're selling raw soybeans and buying soybean oil and soy meal contracts. The profit from the reverse crush spread comes when there is an increase in the price of the byproducts relative to the input costs. Before we wrap this up, I want to give you some reasons why you should start trading soybeans today. Everyone should start day trading soybeans. First, soybeans are the 4th most traded commodity futures contract. Secondly, soybean consumption will start growing mainly because of 2 key factors. Number 1, the world population has been rising continuously and it's projected to reach 10 billion by 2050, which means a growing need for food. Number 2, soy-based foods are increasingly in demand and they are a classic meat alternative. Global warming is also expected to disrupt the soybean supply and demand balance, which can translate into more volatility and more day trading opportunities. In summary, learning how to trade soybeans is easy because the seasonality pattern allows us to clearly forecast future prices. The soybean futures market is a very liquid market that is seasonally driven and has a lot of valuable chart patterns happening daily. The fundamental factors can add extra weight to your soybean trade deals, which makes this commodity one of the most attractive instruments listed on the CME. Here's a quick summary of the most important things to keep in mind. Soybean futures are the 4th most liquid commodity on the CME. This market has unique patterns. The best time to sell soybeans is in June, and the best time to buy soybeans is in August. When the soybean-corn ratio is above 3, expect soybean prices to crash. And lastly, the crush spread and the reverse crush spread helps traders take advantage of price discrepancies between raw soybeans and their byproducts. And that's it for this week's strategy. Come back for my videos on Monday, Wednesday, and Friday at 3 p.m. New York time. Be sure to subscribe and hit the bell for notifications. Have a great weekend, and I'll see you with a couple of trade picks on Monday.